First, let's start speaking about credit. The reason I have this visual up here is because a lot of people have the wrong perception about where they should be at different stages of their lives, especially those who are in their later 20s to early 40s. A lot of people in that age range feel like I should have my finances together, I shouldn't have so much debt, but based on the stats, that is the period of time where you're brokest. Okay, when you have the most debt, and you're not likely to get out of debt at that age. So the pressure and the, what we feel to say getting out of debt at that point, get out of it, get out of that space. The reason being, if you look at the stats that we have up, it says, here's how much Americans owe overall, broken down by age group. If you look, the highest group is between 35 and 54. That's 133,000 to 134,000. The biggest jump is from when you're under 35 to when you are 35. Yeah. So in your 20s to your 30s, you have your biggest jump in terms of overall debt. And then you see towards your 50s to 60s, it starts reducing. And then 65 to 75, it starts reducing even more, almost to the levels of what you were when you were in your 20s. And then by 75 and up, it's an all-time low. So if you look at this, this is how most, and this isn't average, this is the median, okay? The average is the high and the low, what's in the middle. The actual median, what we have here is what's a realistic number for most people. Most people fall in this range. So when we're thinking about credit, you always want to understand where you are in your life cycle. That's how you set your expectations. You want to say, if you're towards the latter part, you're in pay down mode. If you're in the big middle part, you're still building until you can pay down. And the beginning is just starting to get higher and higher. You don't go down, you only go up from the beginning. Credit tips. Let's get right into, a lot of people are concerned about their scores. How do I improve my credit? What are the ways that I can do it the fastest? So first, we're going to start with the first point. Keep your utilization percentage below 30%. 30% is the goal. Now, keeping at least 3 open unsecured credit lines. Usually that's a credit card. Ideally, that's what banks and creditors want to see. Not that you're in debt, but you have at least 3 open. When you go to file and try to get a mortgage, they want to see 2 or 3 open, not just 1. And usually the one that's been open the longest is the best one that's working in your favor. But at least 3, that's ideal. You don't have to do more. Disputing incorrect information. I know this has been going out for everybody. Look, if you didn't have a contract, you didn't sign a contract, you can dispute, clean up your credit. Yes, you can. That's 100% factual. However, I will say you can do that on your own behalf too. You don't have to have someone else do it for you. If you choose to have someone else do it for you, that's fine. But understand that that's something that you can do yourself too. Keeping your oldest credit card open. Whatever your oldest credit line is, when it comes to your credit score, an old file is always scored better than a new file. And your file date is based on your oldest active credit file. So if you're starting to pay down debt and you're starting to close down accounts, you want to try to keep the one you had open the longest open, because that will positively affect your score. Versus if you close that one and then you exchange that one for one that you just opened maybe 2 months ago or a year ago, your score is going to go down, even if you reduce your credit and your debt, it's going to go down. So for people who are trying to get back from bankruptcies, anything that went wrong, and they just can't get a regular credit card, secured credit cards are not just as good, but they're good because they report to the credit bureau every month. So what you can do is you can just get you a secured card. Remember I said you need 3? You can get you a secured card, and when you make payments basically to your own account, what's going to happen is your score is going to go up, and whoever you get a secured card through likely will offer you an unsecured card very quickly. Control what the agencies see. Here's the real key, okay? This is what a lot of people miss when it comes to credit. You're more in the driver's seat than the actual creditors. People say, how? Because creditors only report to the credit bureaus once a month. So if you know exactly when they report, you can control what they see. So think about it for a second. Okay. If you have a credit card, maxed out, $2,000 credit limit, $2,000 balance, right? That looks bad on your credit report, right? It looks horrible. And I said you need to be in the 30% range, right? So what can you do? If you know that typically 2 to 3 business days after your due date, that's when your creditor reports to the credit bureau. Just in case y'all didn't know, 2 to 3 business days after your payment due date. So if you choose on your payment due date to pay it down to where the balance is 30%, if you wait 5 days later and you use bill money, other bill money to pay that down, have you use your credit card to pay bills. See, what you did was on the credit bureau, it's going to show you're 30% lower than your credit line. However, in reality, yeah, you just was that for a few days. But because you know when your creditor reports, you are controlling your report. Now, the overall goal is to pay down your debt. Don't get me wrong. But I'm talking about also how to impact your score. You can control your credit report. Now we have online banking, online bill payment. You can set your bill payer up so that every time that your credit card is due, it pays it, and then you use that same credit card to pay other scheduled bills right after that. So now it's even out of your hands. You know what I mean? Now it's not depending on your memory. You set it up where it automatically happens every single month. Because you're using that not for, I'm going to the grocery store to pay. I'm talking about the bills that you pay on a certain time period every single month. We can schedule that. You know what I mean? All you got to do is make sure the money is there. You know the money is there if you paid the credit card because you just paid it. So you're not worried about is there enough money in there? No, you just paid it, so you do know. And then you know that your other bills will be paid right after that. So that's a way to automate that process.
Is raising your credit limit a good way to get at the savings?
Absolutely. You can always ask for a credit limit increase if you're disciplined enough to handle it. That's the key, because credit limit increases help. They do help. It's better to have a $1,000 balance if instead of having a $2,000 credit line, it's $5,000. That gets you closer to that 30%. So you can ask for more and higher limits. However, if you are in that stage that I was speaking about, which is the last stage, the latter stage of your credit, you should not be asking for credit increases in your credit limits. You can do that in the 20s and your 30s and 40s. When you start the 60s and 70s, no, you reduce that. Because you're not trying to live on credit anyway. But in that time frame, yes, you can do that. But you got to be disciplined, because when you have that available, oftentimes we go to it, even when we don't want to. Be like, vacation, I'm tired. I mean, hey, it happens. So credit scores and home loans. This graphic that I have up here points to the different credit score requirements for different home loan types. And you need to know this because a lot of people don't understand what's the minimum, and then I'm going to give you the real number too. Okay? Minimum 500 on an FHA loan if you put down 10%. The thing about FHA is the more you put down, the more lenient you get. Okay, with your credit score. You're not putting down much, which is go back to the 3.5% minimum for a regular FHA loan, then your score has to be higher. 580 is the least that FHA will approve. Banks will not take you under 600. Okay, there's a difference. Because we hear that, 580, I'm good. Yeah, the FHA says you're at a 580 with the bank. It's not taking a 580. They usually want you between 6 and usually around 620 is the ideal. 620 is the ideal. And if you use some of those tips that I told you, if you're at 580, you can get a 620 like that. Like it won't take much. Jumping from 580 to 620. Jumping from 580 to 720. Yeah, a little tough. Yeah, a little tough. But 580 to 620, not that hard. VA loans require 620. Okay, for anybody veteran, spouse of a veteran, someone that's serving, 620. And VA loans are one of the best loans out there because they take care of like the closing costs. They don't have too many requirements. It's the FHA, they don't have extra insurance. Remember, if you do get FHA, you have to actually pay separate mortgage insurance, PMI. Right. And that's going to go on your payment, which makes it a little bit tougher to make that payment. But I'm going to give you other options to how to get into a home loan outside of FHA. USDA, 640 is their minimum. Conventional loans, Fannie Mae, 620. Usually they still like around 640, but 620 is the minimum. And conventional, straight up, 680. NACA. All right, now NACA.
NACA, too much work.
Woo! However, the reward for NACA is great.
Yeah, cool.
NACA's tough because NACA is like you're in school at college and you have a terrible, it's a good school, but the administration team is terrible. With the paperwork, with getting stuff done, when you turn something in, it takes weeks later, you gotta call and stay on them and stay on them and stay on them. That's nagging. But the reward out of all these programs out here, they cover typically the most. Like you might be able to get to closing with $1,000 on that. And it's a conventional loan. So that's the other part. Remember I told you, most loans are FHA, where you're gonna have to pay that PMI. Conventional loan, you don't have to pay that PMI, so you get more house. Now there are limits, I think it's up to like 500,000 or something, it might even be 700,000, so if you guys are getting $1 million homes, okay, NACA, don't worry, just let y'all know. But, mind you, NACA is a process, it is tough, it requires a lot of patience, because you gotta submit a lot of paperwork over and over and over again. You have to go through counseling, you have to meet their time frame. However, there are less restrictions, there's no income restrictions. Okay, there are no income restrictions. So if you make a lot of money, you can still go through that. There are no minimum household size, age. You don't have to be a first-time buyer. You can use that.
That was my question. Do you have to be a first-time buyer?
No. That's how nice NACA is. Now you can't get two NACA loans, but you can do one.
And then there's no restrictions on your credit as well, is it?
You still have to have a certain credit score, minimally. I mean, they say it's no restrictions, but to get see what it is, the NACA program don't have restrictions, but the lenders tied to them do. So they still want you to be at 620 rims. They still want you there. And which is why when you're not there, what they're gonna do is they're gonna work with the underwriters to help get you there. So they're gonna tell you to do X, Y, Z over time to get you there, and that can be frustrating. But their underwriters, NACA only deals with certain banks and certain lenders. That's not a program that's open to you choose your lender. No, they're dealing with Wachovia and certain lenders that they deal with. So you gotta meet their qualifications. But yes, you do not have to be a first-time buyer to get in. Upfront money needed for purchase. A lot of people don't hear this before they get into the game. Okay, a lot of people start looking at homes. Oh, I got my program is going to pay my closing costs and all this. You still need upfront money. Okay? Here are the things you need. A good faith deposit. I, as a real estate agent, cannot go to another agent that's selling the property on your behalf and say that you want to buy this property and not have any money that's called good faith money. Meaning if you walk away and you shouldn't have, you broke the contract, they're keeping that money. However, it's good faith because outside of that, it's your money for closing. So it's still the same money, it's still your money that's going to be going towards closing. It's not extra money. But they want a deposit which guarantees them if they take the house off the market and then you back out and you back out and you don't have a substantial reason for backing out. It's in a contract for reasons you can back out. Then they're going to keep that money. And people are not going to do deals with you without that money. Because they don't just trust your word. No.